All right, in this video, we'll be doing the IAS 33, which is earning per share. And you should remember this thing, that this earning per share is actually the simplest indicator of the earnings. And you have studied this thing when we were doing the ratios. So simplest indicator of earning. Like for example, if you are communicating even to a layman that you have earned this much amount per share, then they can simply understand it. Okay, for example, if you say someone that you have earned $0.5 per share. So what they're gonna do, simply they can multiply that $0.5 with their total amount of shares, and they can calculate the total earnings. So earnings per share is actually the simplest indicator of the earning. It is calculated as, and before calculation, I'll be writing that listed entities are required to disclose this on the face of the financial statements. So listed entities are required to disclose it. And how it is calculated? It is calculated as so EPS is equal to profit after tax divided by weighted average number of shares. So EPS is calculated as profit after tax divided by weighted average number of shares. So what does we mean over here? EPS is equal to the profit after tax divided by the weighted average number of shares. This means that maybe the entity is issuing the shares during the year. So this is profit after tax. This is simply the earnings. Weighted average number of shares mean these are only the shares. So when you divide earnings by shares, it gives you earning per share. But it is possible that the entity is issuing the shares during the year. For example, if I say, for example, from 1st January to 30th June, 6 months, there were $1, 5 lakh shares. And then on 1st July, company issued further $1, 3 lakh shares. Now, obviously, remember one thing, that what is actually the link between the profit after tax and the weighted average number of shares? Or you can simply say, what is the link between the numerator and the denominator? When the company is issuing the shares, that means the company will be receiving cash from the shareholders. That cash will be invested within the company. When the cash is invested within the company, those cash will be invested somewhere. And when those cash flows are invested somewhere, that will bring the returns to the company. So when the company is issuing the shares, they are collecting the investment from the shareholder. That investment will be spent somewhere, and the spending is going to bring the returns to the company. And obviously it will be the numerator, that is profit after tax. So further investment means further profits. So that is why when the company is issuing the shares, you need to calculate the weighted average number of shares. Now there are two methods to do that. The first method to do is simply, like for example, you are having the 5 lakh shares for the first 6 months, and the entity issued further shares. Now the total shares are 8 lakh. But we need to calculate the weighted average number of shares. So how we can calculate the weighted average number of shares? The 5 lakh shares remains 12 by 12 for the whole year. That gives you 5 lakh. And 3 lakh shares were only available for the 6 months. So 1,50,000. That means total will be 6,50,000. The second way to calculate the weighted average number of shares is 5 lakh shares remain 6 by 12 because after that there were new shares in place. So it will be 2,50,000. And then 8 lakh shares remain for the other 6 months and it gives you 4 lakh. So the total will be the same, 6,50,000. So you can calculate the weighted average number of shares by the two means. So the first one by 5 lakh 12 by 12 and 3 lakh 6 by 12, and the other one is 5 lakh 6 by 12 and 8 lakh 6 by 12. You can do it either way. So this is how we calculate the weighted average number of shares. This is the simple calculation and you are required to learn that. But when the company is issuing the shares, the issuance of shares, the issuance of shares can be in 3 ways. And we're going to discuss that one by one. The first issuance can be share issuance at full market value. That means share is issued at full market value. The second is the shares are issued free of cost to the existing shareholders, and that is known as the bonus issue. The third possible thing is that the shares are issued less than market value to the existing shareholders, and these are known as the right issue. So the share issuance can be of 3 ways. It can be the full market value, it can be the bonus issue, it can be the right issue. So if the shares are issued at full market value, then weighted average number of shares should be calculated. And you know, EPS will be calculated based on the weighted average number of shares. But when there is a bonus issue, then remember that no weighted average. You are not required to do the weighted average. Why? Why is that? Because bonus issue is deemed to occur at start of the year. Like for example, even the shares are issued in December, November, October, anywhere within the year, it will be deemed that the bonus issue has been done at the start of the year. So if we are supposing that, then there will be no need to calculate the weighted average number of shares. Okay. So first of all, you will calculate EPS based on bonus fraction, and then previous EPS, like the EPS of the previous year, previous EPS, that is known as comparative. Comparative should be restated. And in order to understand this concept, you have to do an example, and we are going towards an example. So this is the example of the bonus issue. No, this was the example of the right issue. This is the example of the bonus issue. Yeah, the heading is incorrect. Let me just remove it. So this is the bonus issue. Okay, we are going to do an example. An entity made a bonus issue of 1 new share for every 5 existing shares held on 1st July 2008. So like for example, if you see the 2007, the profit attributable to the ordinary shareholders was 4,60,000 and the number of shares were 1 million. And they issued the shares Further, an entity made a bonus issue of 1 new share for every 5 existing shares. So the fraction was 1 million, okay? 1 million into 1 by 5. That means 2 lakh. So 2 lakh were the further shares, and this is the bonus issue. So now the total shares will be 12 lakh. Okay. Relevant information, the profit, it is 4,60,000 in 20x7 and 5,50,000 in 20x8. The number of shares were 1 million and 1.2 million, that means 12 lakh. Calculate the basic EPS, okay, and calculate the prior year comparative figure. Now I will do some analysis. Like first of all, if I calculate the EPS of 20x7, it will be simply 4,60,000 divide by 1 million. Okay, let me just calculate it. 4,60,000 divide by 1 million. So it is 0.46. 0.46. Now, for example, if you see that the profits were 4,60,000 and it has reached to 5,50,000, the profit has increased. But say, for example, in order to explain you how it works, if I say 5,50,000 divide by 12 lakh, what does it gonna give you? 5,50,000 divide by 12 lakh. It gives you 0.45. Now, if you see, the EPS of the previous year was 0.46, and the EPS of this year is actually 0.45. Now the shareholder is going to think that the EPS has dropped, even though you see that there is the increase in the profit, 4,60,000, and now it is 5,50,000. So if you are not going to restate your comparative, restate your previous figure, then the shareholders will consider it as a drop in the EPS. So now what we're going to do, the previous year profit was 4,60,000. We're just gonna restate it. We're gonna divide it by 12 lakh. Now 4,60,000 was the previous year profit, and we will deem, okay, if last year there were the same shares, that means 12 lakh, the EPS would be 0.38. And now if you compare these two figures, the shareholders can easily understand that there is the increase in the EPS. So the 20x7 figure was $0.46. The 20x8 figure is $0.45. And 20x7 restated figure is $0.38. So now they're going to compare these two. Okay, fine. That due to the bonus issue, the previous year EPS was 0.38 and now it is 0.45. So now the EPS has increased. This is how you're going to calculate the bonus issue. If you're not restating the previous figure, that means it will be deemed that there is actually a drop in the EPS. So that is, I was saying, no weighted average share should be calculated because bonus issue is deemed to occur at the start of the year, and you will calculate the EPS based on the bonus fraction. Previous EPS, that means comparative, should be restated as well. Now, what is the right issue? Right issue is actually the issuance of shares below the market value to the existing shareholders. That means in the bonus issue, no cash was coming into the business and it was not affecting the profitability as well. That is why we were not calculating the weighted average number of shares. But when the right issue occurs, although the company is issuing the shares below the market value, but obviously they will be getting something out of it because they are collecting some money from the existing shareholders. although it is below the market value, but still there is something coming into the business and that will affect the profit. So we have to calculate the weighted average number of shares, but for that there are some steps. The first step is to calculate the theoretical ex-right price. Theoretical ex-right price. The students who have done the F9, they can easily understand it. The students who have not done it, there is no problem. The theoretical ex-right price is actually the market value of the share after the right issue. That is the value of the share after right issue. So you can simply say value of share after right issue. So first of all, you will be calculating that. Then you will be calculating the fraction, right issue fraction. And how the fraction is calculated? The fraction is calculated as share value before right issue divided by value after right issue. So the share value before right issue divided by the share value after right issue. And then based on this thing, weighted average shares will be calculated. Weighted average shares based on fraction. And once the weighted average share is calculated, the fourth step will be the EPS. And the fifth step is restating comparative, just like the bonus issue. So there are 5 steps. The first step is to calculate the theoretical ex-right price. The second step is the fraction share value before right issue divided by share value after right issue. Then the weighted average number of shares based on the bonus fraction, based on the fraction, right issue fraction. And number 4 is calculating the EPS. All right, so now we'll be doing an example. And the example of the right issue, this is the example of the right issue. And somehow I have written over here, I'll be just raising it. Okay, so this is the right issue. An entity issued 1 new share for every 2 existing shares at 1.50 per share on 1st July 2008. The pre-issue market price was 3. So before the issue, the market value was 3. After the, and they issued the shares at 1.50. So this is before, and this is the right issue price. Now we need to calculate the theoretical ex-right price. So the shares were 8 lakh, okay? So 8 lakh shares, and they issued 2 existing share, 1 new share for every 2 existing, that is 1 by 2. That means 4 lakh. So 8 lakh plus 4 lakh makes 1.2 million, that is 12 lakh. Okay, so that is fine. Okay, theoretical ex-right price is simply calculated as theoretical ex-right price is simply calculated as, okay, you first of all, you were having 2 shares, okay, and the share price was $3 per share. It gives you total 6. And then the 1 new share was issued at a price of 1.5. It gives you 1.5. So 7.5 and 3. So the theoretical ex-right price will be 7.5 divided by 3. So how we can calculate that? 7.5 divided by 3. So 2.5 is actually the theoretical ex-right price. And as I said, the theoretical ex-right price is actually the price after the right issue. Now the second step is the fraction share price before the right issue divided by share price after the right issue. And the third step is calculating the weighted average number of shares. Now, 8 lakh shares were there for the first 6 months because the entity issued the shares on 1st July. That means 6 months, there were 8 lakh shares. Multiply by 6 by 12 and multiply by bonus fraction, which is 3 divided by 2.5. And in the other 6 months, there were 12 lakh shares. So 12 lakh into 6 by 12. And there's no need to multiply with the bonus fraction again, okay? So 8 lakh multiply by 6 divided by 12 multiply by 3 divided by 2.5. It gives you 4,80,000, and this will give you 6 lakh, and that means 10,80,000. So this is the fourth step. No, third step. Now the fourth step is to calculate the EPS. I'll be writing over here. EPS is simply profit after tax divided by weighted average number of shares. So 5,50,000 divided by 1,080,000. So 5,50,000 divided by it is 0.509. Now, if you see the previous year EPS was 4,60,000 divided by 8 lakh. So 4,60,000 divided by 8 lakh. It was 0.575. So again, if you compare the previous EPS with this, you will see that there's a drop. So that means you need to restate it, which is step number 5. Step number 5, the restate. How you can restate is 0.575 multiply by 2.5 divided by 3. The bonus fraction, make it opposite. Multiply by 2.5 divided by 3. It is 0.47. Now in the fifth step, you will reverse the bonus fraction because you are restating the previous year EPS. Now if you compare, this year EPS is 0.509, and based on the right issue, if we consider the right issue, even in the last year, the EPS would be 0.47. So clearly there is an increase. Otherwise, if you compare 0.509 with 0.575, you will see that there is a drop. So this was the right issue. You need to have the calculation of both bonus issue and the right issue. Now we are done with this. The last thing we will be discussing in the IAS 33 is diluted earning per share. DEPS, diluted earning per share. What is the concept behind that? If you remember the convertibles, the hybrid instruments, the warrants, what was that? That the bondholder was having the option that they can convert their investment into equity shares, or they can simply take the cash. So they were having the option of that. So now, for example, if the company is having the convertible in place and they are not sure what the bondholder is going to do, whether they will be taking the cash or whether they will be converting their investment into shares. So based on that, we'll be calculating an additional figure which considers that considers the fact that if they converted their investment into share, then the EPS will be this. So that is known as DEPS, diluted earning per share. It is calculated as profit after tax divided by weighted average shares. This is the simple formula. And now we'll be adjusting two things in it. The first thing is the notional interest, and then is the notional shares. Notional interest is actually the assumed interest. Assume interest. Like for example, if they were a shareholder, they will not be taking interest. That means that will be a saving. Notional shares is actually the possibility that if they converted their investment into shares, so these will be the shares which will be added in the existing shares. So we are actually, notional means we are assuming. So notional interest and notional shares. We'll be adding this thing, and that gives you the DEPS, diluted earning per share. So the concept of the diluted earning per share is that we are having a normal EPS, but we are having the convertible in place. There's a possibility that those bondholders can convert their investment into shares. If they converted their investment into shares, then there will be an additional working, which is diluted earning per share, because EPS will change accordingly. So this was your IAS 33.
All right, dear students, we are going to do very important practice for the FR exam, and this is IAS 33, earning per share. You can have this in the exam in the form of the objective test case questions, and also as a part of the final account question, in which we are required to prepare the statement of financial position, the statement of profit and loss. So we mostly see this being tested as part of the final account question, but it can be tested in the objective test case questions as well. So we did IAS 33 when we were doing the standards, and now we are going to do the practice. Garfish had profits after tax of 3 million in the year ended 31st December 2007. On 1st January 2007, Garfish had 2.4 million ordinary shares in issue. On 1st April 2007, Garfish made a 1-for-2 right issue at a price of 1.40 when the market price of the Garfish share was 2. What is the basic earning per share to one decimal place for the year ended 31st December according to IAS 33 earning per share? So you see the profit after tax is 3 million. The basic formula for calculating the EPS is the profit after tax divided by the weighted average number of shares. Now you see on 1st January they were having 2.4 million ordinary shares, and after 3 months they issued further shares, which was the right issue, and this right issue was 1-for-2 right issue at a price of 1.40. And we know, like, whenever there is right issue, we need to do some steps in order to calculate the weighted average number of shares. Like, first of all, we need to calculate the theoretical X right price, TERP. The second step is going to be the fraction. The third step is going to be the weighted average shares. The fourth step is to calculate the EPS. And the fifth step is the restated EPS, which we are not being asked within this question. So we are supposed to calculate the basic earnings per share. Now we know the theoretical X right price is, like, for example, there were 2 shares before the right issue. Take 2 shares. The price before right issue was $2. And when you multiply 2 shares with $2, it gives you the $4. And then 1-for-2 right issue was made, at 1-for-2 shares. So 1-for-2 shares, and it was being issued at a price of 1.4, because we know the right issue is the issuance of share below the market value. Now it gives you 1.4. So $4 plus 1.4 gives you 5.4, and total shares will be 3. So how we can calculate the theoretical X right price is simply 5.4 TERP is equal to 5.4 divided by 3. So by using the calculator, we can just calculate it. Yes, it's 5.4 divided by 3. It gives you 1.8. So 1.8 is the theoretical X right price. Now, we are done with this. Okay, theoretical extra price is, we can write it over here, is 1.8. Now the second step is the fraction. The formula for the fraction is the price before right issue, which was $2, divide by price after right issue, which is 1.8. So it's 2 divided by 1.8. This is the fraction. Now using this fraction, we are going to calculate the weighted average number of shares. Weighted average number of shares. Now how we can do it, just let me just do it over here and then I'll show you the answer. So we are continuing this over here. So 2400 shares, 2400,000 shares were there. Let's take into 000, 2400,000 shares, multiply by how many months, till how many months they were there, till 1st April, then they made the right issue. So these 2400 shares were for 3 by 12, and then multiply it by the fraction 2 divided by 1.8, and then they issued 1 for 2 shares. So when you divide 2400 divide by 2 multiply by 1, it is going to give you 1200 shares. So total shares after the right issue is going to be 3600, and these 3600 shares were for 9 months. And by doing the calculation, let's just go to the answer directly to avoid the time for the calculation. So you see, first of all, we calculated this weighted average number of shares, the theoretical extra price, 5.4 divided by 3 is 1.8. Then we did the fraction, price before right issue divided by price after right issue, and then there is a weighted average number of shares. 2400 were for 3 months, multiplying by the fraction, and the 3600 multiplied by 9 by 12, and then you get the weighted average number of shares, 3366667. So this is the weighted average number of shares. Now we need to calculate the EPS. The EPS thing is simple. So we are going to take profit after tax, which was 3 million. So 3 million divided by the weighted average number of shares which we have calculated. So 3 million divided by 3366667. So you get 89.1 cents. So this 89.1 is your answer. So this is how simply we are going to calculate the EPS. Now be aware of this thing, that whenever you have the right issue, we need to follow the steps: the theoretical extra price, the fraction, the weighted average, and then the EPS. The 5th step is calculating the restated EPS. We are having that thing in another question. In this question we were asked regarding the basic earning per share. Alright, going towards the question number 120. On 1st January 2004, SAM company had 3 million ordinary shares in issue. On 1st June 2004, SAM company made a 1 for 3 bonus issue. Now we know the bonus issue is the issue of the free issuance of shares to the existing shareholders. And we suppose that this bonus issue is done at start of the year. So we need to multiply it by the bonus fraction. On 1st June 2004, SAM company made a 1 for 3 bonus issue. That means previously there were 3 shares in issue, and then they made 1 for 3. Now the new number of shares are going to be 4. So the bonus fraction is going to be 4 by 3. It's simply, there were previously 3 number of shares, then they issued 1 for 3. Now the total shares are going to be 4. So 4 divided by 3 is the bonus fraction. On 30th September 2004, SAM company issued further 1 million shares at the full market price. And we know that whenever they are full market price, we need to calculate the weighted average number of shares. So SAM company had profits attributable to ordinary shareholders of 2 million. So you see there are 3 issuance of shares. On 1st January, 2 issuance of shares. On 1st January, they were having 3 million shares. 3 million shares. On 1st June 2004, they did another share issue. So these 3 million were for 5 months, 5 by 12. And then on 1st June 2004, Sam Company made a 143 bonus issue. Now 143 means that previously there were 3 million shares and now they're going to be 4 million shares. And these 4 million shares will be till 30th September. 30th September. Now you see 4 million from June, July, August, September, 4 by 12. On 30th September, Sam issued further 1 million shares. Now further 1 million shares means now the total is going to be 5 million shares. And these 5 million will be for another 3 months, October, November, December. So 3 by 12. This is the simple calculation. Like from 1st January to 1st June, 5 months. In the first 5 months period, there were only 3 million shares. And then on 1st June, there were bonus issue. Then the shares were 4 million. Then on 30th September, there were further 1 million shares. Then for last 3 months, there were 5 million shares in issue. So let me show you the answer, how we are going to calculate it. But we know that whenever there is a bonus fraction, we assume it at the start of the year. So we are going to multiply the bonus fraction which we calculated 4 by 3 over here. And then we get the answer. So the weighted average number of shares are 4,250,000. The profit is 2 million. 2 million divide by 4,250, and then you get the answer, which is 47.1 cent. This is the answer. So whenever you are having this type of question, be aware that when in the bonus issue, we need to multiply it by the bonus fraction. When we have the right issue, then we need to do certain steps, theoretical extra price and things like that. And then during the year, Mac made a 143 right issue at 1.6 when the market price was 2.2. 143 right issue. Fine. At 1.6. The last year EPS was 87 cents. There were no other issues of the shares during the year. What is the restated earnings per share? We know that in order to calculate the restated earning per share, we need to multiply it by the reverse fraction. Now, first of all, we need to know the fraction. And before knowing the fraction, we need to calculate the theoretical X right price, which is the first step. Before right issue, there were 3 shares in issue. Each share was 2.20. And then there were 1 for 3 at the rate of 1.6. So we can calculate it. 3 into 2.2. 3 into 2.2. It gives you 6.6. And then this is 1.6. So 6.6 plus 1.6. It gives you 8.2. So 8.2 divided by 4. 8.2 divide by 4. What we get? So it's 8.2 divide by 4. We get 2.05. This is the theoretical extra price. Now the fraction thing is easy. Price before right issue 2.20 divide by price after right issue 2.05. Now in order to calculate the restated EPS, we need to reverse the fraction. So take the previous year EPS, which is 81 cents, multiply it by the reverse fraction. So 2.05 divide by 2.0. So we can just directly go to the answer to see what it is. Okay, so we are having it on the next page. So yes, multiplying it by the reverse fraction, 81 cents multiplied by 2.05 divided by 2.0, we get 75 cents, which is the answer. Okay, now we have the question number 122. Remember, we are doing this from the latest Kaplan kit, so you're having probably the same number in your exam kit as well, for just telling you for the reference. Coral Company has net profit for the year ended 30th September 20x5 of 105,000,000. Coral has had 6 million shares in issue for many years. So this is the net profit, and the number of shares which are in issue is 6 million. On 1st October 20x4, Coral issued a convertible bond. It had initial liability element of 25 lakh, which is 2.5 million, and the market interest rate for the non-convertible instrument is 8%. The bond is convertible in 5 years with 50 shares issued for every 100 nominal of the convertible bond held. Coral pays tax at the rate of 28%. What is the diluted earning per share? Now we know that in order to calculate the diluted earning per share, first of all, the basic formula of the EPS is profit after tax divided by the weighted average shares. Now, when you are calculating the diluted EPS in addition to the normal EPS, you need to add the notional profit and the notional shares. Now the profit which is given to us is 105,000,000. Now we need to add the notional profit into it. The notional profit. And then the number of shares which we have is 6 million. We need to calculate with the notional shares. So how we can do that? Okay, simply. First of all, let's calculate the notional shares. Okay, so the number of shares which are in issue is 6 million. Okay, they said the bond is convertible in 5 years with 50 shares issued for every 100 nominal of the convertible bond held. So you see the liability element is 25 million to 2.5 million, so 25,000,000 divide by 100. For every 100, it is written with 50 shares for every 100, so divide by 100 into 50. So we can just calculate it. 25 lakh divide by 100 into 50. So it is 125,000,000. So it's 125,000,000. So when we calculate it, you will get the weighted average shares alongside the notional shares. Okay, now we need to calculate the profit with the notional profit. So let me just take you to the answer in order to save the time for the calculation. So you see the basic earnings is 105,000,000. And you see when they're getting the shares, obviously the interest will be saved, so we need to add back the interest saved. The liability element was 2.5 million and the rate of interest is 8%, so 2.5 million into 8%, 200,000 will be saved if they are getting the shares rather than the cash. And then the tax, which is on the earnings, because when you add the interest saved, there will be tax implication as well. So 200,000 into 28%, 56,000. And the adjusted earnings for diluted EPS is 106,440,000. We have already calculated the shares for the EPS, so you just do the calculation. 106,440,000 divided by 7250, and the diluted earning per share is 146.8. So remember, the concept is that we calculate the diluted earning per share when there are convertible bond in issue. The convertible is that the bondholder has the option, either they can take the shares or the cash. So if they're taking the shares, then the company will not be giving them the interest. The interest cost will be saved. That is the notional saving, notional profit. So whatever the earnings are being given to you in the exam, you need to add that notional savings into it. And then obviously the tax implication as well. You deduct the tax implication. So you get the adjusted earnings. And then you need to calculate the notional shares as well. That if they are taking the shares, how much they will be taking. The fraction will be given, like in this question, 50 shares for every 100 nominal bond. So you take the value of the bond, divide by 100, multiply by 50. So this is how you are going to get the answer. So the answer is 146.8. It is the D option. Okay, then we have the ISCO's financial statements shows a profit for the year to 31st December of 2 million. Okay. On 1st January 2005, ISCO had 4 million shares in issue. So the profit is 2 million, shares in issue are 4 million. And made no further issue. Okay, fine. At 31st December 2005, there were 1 million outstanding options to buy shares at 3 million each. There were 1 million outstanding options to buy shares. Okay. For the year to 31st December 2005, the average market value of the ISCO shares was 5 million. What is the ISCO diluted earning per share for the year end? Again, for the diluted earning per share, we need to calculate uh, the notional profit and the notional share. So we do not have anything pertaining to the notional profit over here, but we have something related to the notional shares. Those notional shares need to be calculated. Okay, how many options are there? 1 million options. 1 million options to buy the shares at $3. So 1 million into $3 will be 3 million. 3 million. For the year to 31st December, the average market value of ISCO share is $5. You know, these 3 million is not it's not the dollar. These are the 3 million options. So when you convert 3 million options into the shares, 3 million divided by $5, you get 600,000 shares. 600,000 shares. Now you see 1 million outstanding option. 1 million is 10 lakh. So out of 10 lakh, 600,000 are this, and the rest 400,000, sorry, it's not again dollar, 400,000 are going to be the notional shares. So you see, let me show you the answer. So to calculate the diluted earning per share, you need to work out on the number of free shares. So you see 3 million options are there. 3 million multiplied by $1 million multiplied by $3, you get 3 million. 3 million divided by 5, you get 600,000 shares. The total options are 1 million. Out of 600,000, 600,000 are for 3 million. The rest would be free. 400,000. So you add up 4 million existing shares plus 400 notional. 2 million is the profit. So 2 million divided by the notional shares, then you get 45.5 cents as the answer. Then we have question number 124. Grommet has the following extract for its consolidated profit or loss account. Profit for the period of the comprehensive income, then profit attributable to parent, NCI, total comprehensive. What figure should be used as earnings by Grommet in its earning per share calculation? So when you talk about the Grommet, they will be taking profit attributable to parent, not the NCI. So it's 2250. This figure should be put over here.